Everyone thinks they know what's driving America's economy. Some blame inflation, others blame the Federal Reserve. Some point at Washington, others point at Wall Street. But what if all of them are looking in the wrong direction? What if wrong direction? What if one of the biggest forces shaping your mortgage, your retirement account, and even the stock market isn't sitting inside the White House, or Notch, or the Federal Reserve, or even the United States? It's happening nearly 7,000 miles away. And chances are, you've never heard anyone explain it. Because while millions of people are busy debating AI, elections, and the next big tech company, a silent shift has already begun inside one of the world's most overlooked financial markets. It's slow, it's complicated, it doesn't make flashy headlines, but it has the potential to change the cost of money across the entire global economy. And if that sounds like an exaggeration, stay with me, because by the end of this video, you'll understand why. Some of the smartest investors on Earth have been watching Japan far more closely than Silicon Valley. And once you see it, you'll never look at interest rates the same way again. Let's start with something that confuses almost everyone. The Federal Reserve has talked about lowering interest rates. So why are mortgage rates still painfully high? Why does borrowing still feel expensive? Why do markets suddenly panic even when inflation reports seem to improve? Most explanations stop at one sentence: the Fed controls interest rates. That sounds reasonable, but it's only part of the story. Because the price of money isn't controlled by a single person or a single institution. It's shaped by millions of investors making trillions of dollars worth of decisions every single day. And one country has quietly influenced those decisions for decades: Japan. Not because Japan wanted to control America's future, but because global finance rewards simple math. For over 30 years, that math benefited the United States. Today, that equation is beginning to change, and when the math changes, everything else eventually follows. Stocks, housing, corporate borrowing, government debt, even the monthly payment on an average American home. This isn't about predicting a market crash. It's about understanding a force that has been hiding in plain sight. And once you understand it, you'll begin noticing connections that most financial headlines completely miss. Here's the biggest mistake people make when trying to understand financial markets. They focus on the loudest stories: the election, inflation, artificial intelligence.
Breaking news. But markets don't always move because of the loudest headline. Sometimes, the biggest changes begin with the quietest events. Think about
the bridge. Most people notice the bridge only after it collapses. Almost nobody pays attention when tiny cracks begin to appear years earlier. Financial markets work the same way. The real signals usually aren't dramatic. They're gradual, hidden, easy to ignore, until suddenly, everyone notices them at once. And that's exactly why professional investors spend so much time watching markets that most people never think about. Because by the time something becomes front-page news, the smartest money has usually been preparing for it for months or even years. So before we talk about what Japan is doing today, we need to travel back to a completely different era. A moment that changed global finance in ways most people still don't realize. And strangely enough, it all began with one of the biggest financial bubbles in modern history. To understand what's happening today, we need to go back more than 3 decades, not to New York, not to Washington, but to Tokyo. Because before Japan became one of the world's most important financial players, it was the center of one of history's greatest economic booms. During the 1980s, Japan looked unstoppable. Its companies dominated global markets. Its technology was envied around the world. Its economy was growing at an incredible pace, and confidence reached dangerous levels. Real estate prices exploded, stocks soared. People believed prices would never stop climbing. At one point, the land underneath Tokyo's Imperial Palace was famously said to be worth more than all the real estate in California. Whether every comparison was perfectly accurate wasn't the point. The point was simple. Optimism had turned into speculation, and speculation had turned into a bubble. Then, reality arrived. Almost overnight, asset prices began collapsing. Stock markets lost massive value. Real estate prices fell for years. Businesses stopped investing. Consumers
stopped spending. Confidence disappeared. An entire generation watched wealth evaporate. Economists would eventually give this period a name that still echoes today. Because what
was expected to last a few difficult years stretched into decades of sluggish growth, weak inflation, and an economy struggling to regain momentum. Imagine,
you're responsible for running the country's central bank. Businesses aren't borrowing, consumers aren't spending, prices aren't rising. Economic growth feels frozen. Normally, central banks
lower interest rates to encourage borrowing and investment. So that's exactly what Japan did. Rates were cut, then cut again. Eventually, they were pushed
to levels the modern financial world had barely experienced. Money became incredibly cheap to borrow. The hope was simple. If borrowing becomes inexpensive enough, people will spend, businesses will invest, and the economy will recover. But the recovery never arrived the way policymakers expected. Instead, Japan entered a financial environment unlike almost anywhere else in the developed world. For years, then decades, borrowing costs stayed extraordinarily low. That decision wouldn't just reshape Japan, it would quietly reshape global finance. Now imagine you're managing billions of dollars for a pension fund, or an insurance company, or a large investment firm. Your job is simple: grow your clients' money while taking reasonable risks. But there's one problem. The safest investments are in your own country are barely earning anything. Keeping your money at home means accepting tiny returns. So naturally, you start looking elsewhere. Not because you want to leave Japan, because your investors expect better performance. And that's exactly what happened. Japanese institutions began investing beyond their borders. The United States, Europe, Australia, emerging markets, wherever stable returns could be found. Over time, trillions of dollars flowed into global financial markets. It wasn't driven by politics. It wasn't driven by emotion. It was driven by arithmetic. Capital simply moved toward better opportunities. And for decades, the United States offered
many of them: American government bonds, corporate debt, mortgage-backed securities, large public companies, technology stocks. Japan supplied enormous amounts
of capital. The relationship benefited both sides. America gained a steady stream of investment. Japanese institutions earned stronger returns than they could find at home. For years, the system appeared remarkably stable. So stable, in fact, that many investors started assuming it would last forever. History has a habit of punishing those assumptions. Because every financial system depends on one thing: a rule everyone believes will never change. And eventually, that rule almost always changes. In Japan's case, it was the cost of borrowing itself. And when that began to move, it triggered one of the
most important shifts in global capital flows in decades. That's where our story goes next.
At this point, you might be thinking, if Japan kept interest rates low for decades, why does that matter to someone buying a house? In Texas, investing in the S&P 500, or running a business in Ohio? The answer lies in one of the most powerful and least understood different strategies in global finance. It's called the carry trade, and despite the complicated name, the idea behind it is surprisingly simple. Imagine Michael. He manages hundreds of millions, a professional investment manager. His job is not what you think. His job isn't to predict the future. His job is to find opportunities where the math works in his favor. Now imagine Michael discovers he can borrow money in Japan at an extremely low interest rate, far lower than almost anywhere else in the developed world. Instead of leaving that money in Japan, he exchanges it into US dollars. Now he has options. He can buy US Treasury bonds, investment-grade corporate bonds, large American companies, even carefully selected real estate investments. As long as those investments earn significantly more than his borrowing costs, the strategy can be profitable. Multiply that decision by thousands of banks, insurance companies, pension funds, hedge funds, asset managers, and institutional investors around the world. Suddenly, it's no longer one investor. It's a global river of capital. Here's something human nature rarely changes. When people see a strategy working, when everyone follows, they copy it. When institutions see billions being made, they study it. When investors believe borrowing will remain cheap, they become more confident taking risk. Over time, this wasn't just another investment strategy. It became part of the financial system itself. Cheap money encouraged more investing. More investing pushed asset prices higher. Higher asset prices attracted even more capital. The cycle fed itself. For years, it looked almost unstoppable. And because the process happened gradually, most people never noticed it. The average family wasn't thinking about Japanese interest rates. They simply noticed stock portfolios growing. Businesses found it easier to raise money. Credit remained widely available. Liquidity quietly flowed through the system. Think of liquidity like water flowing through
The city. When water is abundant, everything works. Homes have running water. Businesses operate. Construction continues. Life feels normal.
But when the flow begins slowing, the effects don't appear everywhere at once. Some neighborhoods notice first, others much later. Financial markets behave in remarkably similar ways. Every major financial system has one hidden assumption, one belief almost everyone accepts without questioning. In this case, the assumption was simple. Japan would keep borrowing costs extremely low. Year after year, investors built strategies around that belief. Risk models assumed it, banks planned around it, funds allocated capital based on it. Entire portfolios were designed with that expectation in mind. And after decades, it didn't even feel like an assumption anymore. It felt like reality. But markets have a way of reminding everyone that nothing lasts forever. Policies change, economies evolve, inflation returns, and when those conditions change, the old math stops working. That's exactly what began happening, not overnight, but gradually enough to make professional investors pay attention. Because once borrowing becomes more expensive, the entire equation changes. The strategy that once looked almost effortless suddenly demands much more risk for much less reward. And when the reward shrinks, money begins searching for a different home. This is where many headlines get the story wrong. People assume this is only about Japan. It isn't. It's about global capital flows. Money doesn't recognize national borders. It follows incentives. It follows opportunity. And above all, it follows returns. When trillions of dollars begin changing direction, the consequences don't stay inside one country. They ripple through bond markets, stock markets, housing markets, corporate borrowing, and eventually, the everyday economy. That's why some of the world's largest financial institutions spend so much time tracking these shifts. Not because they know exactly what will happen next, but because they understand something most people don't. When the flow of global money changes, everything connected to that flow eventually feels the impact. And that's exactly what started happening when Japan made a decision that many people outside the financial world barely noticed. A decision that forced investors everywhere to ask one uncomfortable question. What happens when the world's
cheapest source of money isn't cheap anymore? The answer to that question may explain why America's financial future could look very different over the next decade.